All right, welcome to our guests joining us for what is to be the first iteration of a series of crypto-based webinars hosted by Primerio. My name is Chris Clifton, and I'm joined by my guest panelists, Tatenda Namachema, the Chief Legal and Compliance Officer at OVEX, which is one of South Africa's largest and leading exchanges, and Loretta Joseph, who's the Deputy Chair of the ADC Forum. Welcome to both of you, and thank you so much for making the time to join us. Firstly, I'd like to start off with, I think I'd be remiss if I didn't refer to the significant recent developments in the crypto space, which is the collapse of FTX. I'd like to hear from each of you what, in your view, caused FTX's sudden and rapid downfall, and what the effect on the South African, and global markets are. Tatenda, I don't know if you'd like to maybe start us off with that.
Yes. So the shock with FTX, it's significant for crypto and the market. Informally, we're referring it to as our Lehman Brothers event. What caused the issues at FTX, for the most part, a lot of it has been published, has unraveled. But it boils down to just poor management. There were too many conflicts there, and there was a lack of oversight, both internally and by regulators. And that's what it is. Essentially, what was happening is that you had FTX Trading, the company which owns the platform and which actually does the trading, that's incorporated at Tigger and Bermuda. And then you have Alameda Research, the prop trading arm of what's in the FTX group. So Alameda was trading with FTX. FTX bailed out Alameda a couple of times. Alameda was taking out leverage. But at the same time, the security being taken for the leverage was FTX's own native token, FTT, which didn't really have any utility apart from being able to be applied within FTX's exchange. You'd get trading discounts and so on with that. So just from the first level, Alameda shouldn't have been taking on huge positions, leverage positions with FTX. That's the first conflict. The second thing is the passing on of customer funds and the poor collateral. Right? So if you go to FTX's terms right now, they're static somewhere. They claim to say that they don't lend out funds and so on without permission. Some exchanges they do, they operate some fractional banking type thing, which is fine. But already in terms of their commercial business arrangements, that they were not supposed to do that. And then you go to the third thing, the type of collateral they were getting was completely poor. And then you have Binance in the name of CZ, and they're holding a big chunk of FTT. So they can actually push the market down and they can manipulate the price of FTT. And keep in mind, Binance is FTX's largest competitor. Albeit Binance invested in FTX early on, but you were reaching levels where FTX was encroaching a lot on Binance. The relationships between CZ and Sam are rumored to have fallen out. Well, Twitter's anything to go by. You can make sense of it as you want. And I suppose the straw that broke the camel's back was CZ. After a leaked balance sheet of FTX, of Alameda, made the rounds, that they were technically insolvent, and most of the carry was an FTT, and CZ announced on Twitter that he was going to offload a chunk of it, and that shocked the market. What followed is a typical bank run on FTT. The only value in that collateral was really market sentiment and the FTX exchange itself. So that quickly lost its value, wiping out a lot of assets on essentially was FTX Trading's balance sheet, and this affected its liabilities to its current users. But that's the story around the FTX. It's a lack of regulation, lack of oversight, poor management. There were a lot of conflicts. you can point fingers to the management within FTX, to regulators as well. But also you had significant market participants trading within FTX. You had established hedge funds. No one said anything. FTX didn't have a CFO. They didn't have a board. And they're raising millions and millions of dollars, and they're valued at billions and billions of valuations. And this all was kept quiet. Granted, SAM and FTX, they did quite a lot of lobbying around the regulation front, and they tried to be in regulators' good graces and so on.
What are your thoughts? And I'd like to also maybe say, if it was so patently obvious, which I mean, in retrospect, it appears to be, why wasn't this picked up sort of ahead of the time?
So, all right, we'll take it back. We'll break down. We'll go back to, I don't think this was the Lehman Brothers moment of crypto, because I traded actually in the GFC. I was an option trader at the time. And we were talking about it before. I don't think the collapse of FTX had anything to do with Bitcoin or the underlying asset. It was a derivative centralized exchange platform that was, as Tatenda was saying, was completely out of the realm of proper fit and proper management of a company and proper regulatory oversight. So, if you're looking at centralized exchanges, they act as intermediaries. They still hold customers' money. I think there has to be a very clear distinction. If you're going to act as a centralized exchange, an intermediary in the market, you need to be regulated. So fit and proper management, segregation of client monies didn't happen. Audits were not asked. There was no board meetings. There was all the general things that happen in the scope of companies operating under regulators. We were just talking about it before we actually went live. I mean, honestly, FTX could have been trading jelly bean derivatives, and they probably would have had better oversight because jelly beans are a commodity. But it was one of those scary moments, and I think the GFC showed this as well. When a lot of quant guys are in rooms, people tend not to ask them too many questions because they don't want to appear stupid. And I think that was probably one of the issues of the regulatory oversight of this particular fiasco. It was a blatant mismanagement by the company, and it was also lack of regulatory oversight. But on the flip side, you're right, Tatenda, you talked about CZ and the SAM. This industry is new. It is still very in its infancy. It still doesn't have that many grown-ups in the room. And for a tweet to be sent out that caused the collapse of a company by another CEO of a company is pure market manipulation. It wouldn't happen in a normal regulated world because you wouldn't be allowed to do it. So it was the catastrophe of many things. And the problem is, I've been writing regulation around crypto assets for many years, almost 9 years. The countries that I've worked with, you don't hear in the news because they had proper regulatory frameworks in place that an FTX would never be able to operate in, and probably questionably people like Binance, because under regulatory frameworks, you have to have civil penalties, so that comes under security regulators, where you get money fined. And I think also when you're looking at how these firms operate, you have criminal penalties. So if jurisdictions, I guess, that are trying to be innovative, that are small, are looking for the next billionaires, because there are a lot in crypto, still have to be very mindful that if they're acting as centralized exchanges, they're just operating businesses that need to have exactly the same parameters of risk around how to manage that risk as you would any other company operating in any other financial markets or any other financial product. And I think these were financial products, and I don't think any of us can argue with that. But it's given the industry such a bad, overview again for now, what we saw institutional investors starting to come into a market. You're right, Tatenda, when you said like the likes of Sequoia and the Ontario Pensions Fund and these investors that were investing in Sam or this kid, you are go and ask, and you look on the public records, there was no audits, there were no board meetings. These investors don't operate like this in other markets. So this is what happens when you have very immature asset classes. You are going to see these big downfalls, and this one happened to be a calamity of unprecedented proportions, but it had nothing to do with the underlying asset. And I think we need to remember that. It had nothing to do with Bitcoin. As I said, it could have been trading jelly bean futures for all we care, but it has had such a bad ramification on the industry because the institutions were just starting to come in, and now we've put ourselves back maybe 5 or 6 years in the realm of regulatory requirements that you're going to see by regulators now from the FTX debacle.
So I was just going to mention, there is the silver lining of this. So the industry is still very young and it's still maturing. So you need an FTX type thing. So with each failure, albeit catastrophe, as with FTX, there is a silver lining. So regulators are now, well, hopefully, this has opened their minds to actually what is it that they should be focusing on in terms of regulation. Custody being a big thing. And perhaps not just focusing on the AML and CTF and risk management, as you would in typical financial markets.
And I think you're right. Custody is the most important thing in this. Like, you're talking about a decentralized asset that is held by centralized exchanges on behalf of clients in a centralized database. I mean, if you look at some jurisdictions, they have custody, risk management, segregation of client accounts. So you can't just take one bad experience in one jurisdiction and say this is what it looks like around the world, because there are jurisdictions that have done this very, very well. You just don't hear about them come in the news at the moment.
On the custody issue, I mean, are we likely to see consumers or customers taking custody of the assets themselves and not keeping them with exchanges? Is that a possible solution?
I mean, I think that is. I mean, I hold custody of my own assets, but I understand the technology. And I think that's why, I mean, I wrote the first custody regulation in Mauritius, I think, in 2018. And it was the one thing, I mean, I've been in this industry a long time, since 2012, that really kept me up at night, because custody of this decentralized asset is very, very important. And it's not just how you hold money in a bank or gold in a vault. The requirements around the cybersecurity risks and how you can actually make sure that centralized exchanges are holding custody of clients' assets safely is a very, very long and arduous process. But we've done it in certain jurisdictions, and I think custody will become important, but I don't think people want to hold their own custody unless you really understand this ecosystem. I think to drive major adoption, you are going to have, like, people go and put money in a bank, or they hold, gold in a vault. There will be situations where you just need proper regulations that say, all right, if you're holding, custody of people's assets, this is what you need to do. Now, those rules don't change a huge amount when you're just looking at custody. We have custody requirements across banks, across all sorts of financial institutions we've had for a very long time. They follow the same principles, but because this technology is so different and this asset is what is decentralized, you really do need to have a much deeper think about what that custody looks like. And custody, I think, will become, across most regulators, top two things you'll see probably in the next 6 to 12 months across everywhere.
So you will see, people moving into self-custody. And Alicia mentioned this. You have centralized businesses, centralized entities, essentially holding the decentralized asset, which was not the intention around Bitcoin, right? So you want freedom, you want to move away from the establishment, but you've just gone back to the establishment, right? So everything that makes the establishment vulnerable makes the entity vulnerable. It's businesses. They trade, they take on risk. They're only good as the assets that they hold on their balance sheet, really. If all of us are creditors and we keep our funds there. But self-custody is a bit, you need to have some level of sophistication to handle your self-custody. So we operate an exchange, and sometimes there are just niggles just around the technology itself. Around self-custody. So you will find the sophisticated participants moving into self-custody, or perhaps custody with other service providers who specifically provide custody. But from a retail perspective, we don't expect to see people getting into self-custody. The technology and the burden around your own custody it's a bit difficult for the retail user.
And I think that's right. When we're talking about people trading on platforms, if you're trading an asset, you want to be able to make that asset very liquid. When you hold self-custody of these decentralized assets, that becomes a little bit more complicated. The cybersecurity issues around it. So I don't think that's going to become mainstream. I think people will always use the custody of a third party or an exchange if they want to trade and have liquidity moments. So that's why I think custody will become probably. Actually, I'll say now. I think the number one priority of most regulators around the world in the coming months.
How do the exchanges following this event engender trust in the general public? What needs to be done from their side, and also maybe from a regulatory perspective to facilitate that?
Well, I mean, I think if you're looking, okay, well, I'm going to also say a thing here. Crypto exchanges are not exchanges in this true sense of what we think about when we think of stock exchanges. And I think this comes back to the ecosystem. I always say to the technologists that Bitcoin, had they have called Bitcoin Zen token, you probably wouldn't have upset a whole bunch of central bank governors and upset regulators to the point of wondering. They were very good at borrowing terms. So crypto exchanges are not exchanges in the true sense of the word. A security exchange is a public partnership. It's got very onerous regulations around it because these things are effectively infrastructure of a country. A crypto exchange is nothing more than a matching engine. But having said that, and they don't take risks. So when I give, when I move my asset, say, onto an FTX or Binance, in a normal security exchange life cycle, there's something called novation. So the exchange takes on the risk of the buyer-seller. This doesn't happen in crypto exchanges. They're just matching engines. But they still need to have a level of, market infrastructure requirements that regulators require of security exchanges, but they shouldn't be at that level. But, not front-running orders, just doing all the normal, the housekeeping and the fit and proper requirements that a regulator would ask of a matching engine, I think are very reasonable, and those regulations exist all over the world for different exchanges. So I think you will see in the next few months much broader and much more, industry-centric regulatory frameworks around market infrastructure. Not front-running orders, liquidity issues, all the things that normal exchanges follow, but in probably not that much detail, because they're not these things are not public infrastructure. They're just matching engines.
You do see a hybrid towards that, right? So if you're looking at matching engines, it's exchanges which operate on an order book, right? You're matching buyers and sellers, FTX, Binance, and so on. So I suppose the best example I have is us, right? So there's like a hybrid model. So we do it OTC. So we would be the counterparty in every transaction. But just from that, so you've got a different. There's a variety of ways crypto asset exchanges or service providers, whatever you want to call them, are operating, and it's important for regulators to actually understand how the business works, and you will have specific examples or specific regulations tailored to a specific business and how it operates. So in a business as ours, as we trade OTC. The risks are a bit higher. You do need to take care of your risk management and so on. Not so much as with order books and in the South African context, Vela does. Vela and Luna would be the best examples of order book exchanges. But there's a lot of learning and there's a lot of understanding that needs to go into crafting the regulations and what would apply to a specific and business, and we don't really know what that looks like, what licensing will look like. If there are any specific categories under that licensing, and granted, this is not going to be. There is no global concerted efforts to at least come up with some harmonization, right? So I think probably the closest you have to that, which appears that it may work, is probably ECO in Europe. But for the rest of the world, everyone seems to be doing their own things. Again, the focus is ML, CTA, which is not particularly the case. So, and at the same time, you need to interrogate exchanges, right? So, again, Loretta touched on this. So you tend to have people liking them to stock exchanges, the JSE and so on. Maybe it's an easier comparison to make, but they're hybrid things going on. So these guys are providing liquidity to an extent. They're operating as banks. So you've got some fractional reserves or banking going on in terms of how they deploy liquidity, whether it's within the exchange or whether it's external to the exchange.
But none of these things are old. Like we have these things in other markets, in financial markets, and hybrid exchanges and matching engines across every other asset class. So none of this is new just because the technology is new. So and I think regulators are starting to understand that and to apply a basic level of regulation, which, if you're looking at it from a regulatory perspective, just to protect consumers and investors, they're very different. Different levels of regulation require different levels of oversight and management. But if we're looking at consumer investor protection, that's looking at market infrastructure, custody, things that make businesses run right. If you're looking at AML/CTF, I mean that's a very different regulatory framework, because that's to stop the risk of money launderers and terrorists using these platforms, for illicit and proceeds of crime. And I don't think they operate as banks per se, because I don't think prudential regulators really need to be looking at them as banks, because that's just a new level and another level of regulatory oversight that's going to be very, very complicated and very, very layered and very, very intrusive for the industry.
The chair of the SEC, Gary Gensler, I mean, his view, it seems to be sort of disagree with you. He reckons that the existing laws and regulations are sufficient and that it simply need to be adhered to and enforced, essentially. It sounds to me what you both agree that it's not as easy as that, and actual tailored legislation or regulations need to be developed in order to deal with these markets.
Yeah, I mean, Gary and I know each other very well, and we always have this argument, because I don't think you can say that everything is a security in the world of a digital asset or a crypto asset. I think there are certain protocols that do act as securities, but Bitcoin itself is not a security. And I think what I've been saying, because I do a lot of advising, I was just at the G20 as we were talking about. I work with the FATF and the FSB, and I think if you're looking at from what regulators are saying, same risk, same regulatory framework, same outcome. I think that's the wrong way to view this. I think you have same risk, different regulatory approaches, because when we're looking at things like DeFi, and they don't fit into any category that we see, say, in a security, in the security market or in the commodities market, same outcomes. So I think there needs to be a tailored regulatory framework, because things, we're looking, as I said, decentralized finance, and we're looking at some crypto assets, they don't fall into the bucket of being a security or a commodity. I think Bitcoin can probably be termed a commodity. Ethereum probably sits somewhere between. So you actually have to look at the rights of these tokens and what the rights that are attached. But I don't think you can call everything blanketly a security. I think that's that may work in the US, but I don't think that's going to work in other jurisdictions and across the world. I think same outcomes. If we would all work together and say, same risk, same outcomes, but regulatory framework needs to be specialised between the way we get from the risk to the outcome. I think that's what this industry really, really needs.
And I agree with that, right? So it should be outcomes based. If you're going to police this, there's certain mischief you want to address, and you want to look at that, right? So you don't want to go at every nail with a hammer and try to make everything fit. You can borrow the principle that you have in existing frameworks, consumer protection, and so on, risk management, that boils down to that, and you'd look into your custody arrangements and so on. But you'd look at how to achieve the same outcome with digital assets. Right? So, perfect example, your custody arrangements are just not going to be the same by virtue of these assets not being physical, tangible assets. I can't lock them up in a safe somewhere and get some intermediary to exercise custody of these banknotes or gold coins or bullion bars and so on. It's a bit different, and I think it calls for a little more effort on regulators' part. Especially Gary. He taught some one of the first crypto courses at MIT, so stuff we don't really expect from Gary. He should know better.
I agree. And I do think that we also need to, when we're talking about regulation, and I've been saying this for the last 5 years that I've been writing regulatory frameworks, that we need aligned regulatory terms, because at the moment and as the industry we're really struggling, because the Financial Action Task Force, which is the AML-CTF standard setter, so they stop money laundering, terrorism financing, they refer to virtual asset service providers, i.e. probably an exchange or a virtual asset, as a very specific definition. So they refer to a virtual asset as a virtual asset service providers as being a digital representation of value that can be traded, transferred, or used as a unit of payment. If you look at the securities commissions around the world, IOSCO, their rhetoric, what comes out of the SEC in the US, they talk about a digital asset, but we can now digitally represent any asset. It can be a tangible, non-tangible, it can be a security, it can be a fixed income product, it can be a cryptocurrency, but it's not the sleuth of covering everything. And then, we've now got the prudential regulators that come under the Financial Stability Board. They're talking about a crypto asset. Is a crypto asset the same as a virtual asset? I think it might be, but there's no definite clarifications from each bucket of regulators if they're talking about one and the same thing, or they're talking about much broader categories of assets.
Absolutely. And I mean, that sort of aligns with the recent declaration of crypto assets as financial products in South Africa. I'm interested to hear, Tatenda, what have you seen as a response to that declaration? How has that impacted the market?
It really hasn't impacted the market. So this is something that we were waiting for, and it just happened to come at this particular time. We believe that the final push was the threat of grey listing on South Africa. That pretty much got them to move a little faster. But we've been following this. I think the first time there was a draft declaration was maybe 2-3 years ago, and we were waiting for this to come through. Most of the bigger exchanges in South Africa would have already aligned their systems towards compliance within the financial services regime. So nothing much really changes for us. It's something that we do welcome. It will bring legitimacy to the industry. It opens up the industry to other participants. Hedge funds, private equity has been a bit hesitant to get into crypto, just from South African perspective, just because of the unregulated nature, as well as your relationships with third parties who you need in this ecosystem. Right? So. These would be banks, payment providers, and so on. It's from the most basic things. It's difficult for exchanges or crypto asset service providers to get bank accounts, and this is something that's vital for centralized exchanges, because that's you need to on ramp into crypto. That's how the public will get their first taste of crypto. There has to be an exchange that takes place between fiat from crypto. So it's something we welcome. We don't expect the change to be significant or to send any shocks. It will weed out some bad actors, just due to the hoops of applying for a license and so on, which is particularly great in the South African context. And we are plagued from scams. There's quite a lot of scams that happen through the South African market. And it's not just the South African market, but it's typical for African markets. So you have a lot of scams around crypto. So the consumer protection element is what we bring, and also the legitimacy for exchanges and other providers is something that we'll welcome, that we expect to follow.
So if you go back, you backdate to where regulations started to come from. Originally, securities regulators, the people that look after consumer investor protection, have sort of kept crypto out of their gaze, which I think will change very soon. Prudential regulators, i.e. central banks, have been a bit worried more about the impact on currencies, but we've seen that that's probably not going to be, because in my mind a crypto asset is not a currency, it's more a commodity. So the Financial Action Task Force, which is the standard setter for AML-CTF, they started to worry about what they call virtual assets. So, and I think this is the problem, like Tatenda, we're talking about a crypto asset or a virtual asset. I think they're the same thing across the different buckets of regulators. So they started to talk about the risks for purposes of money laundering and terrorism financing way back in 2015. And so in 2019, they said, all right, if no other regulator, i.e. the prudential regulators, the central banks or the securities regulators are going to regulate this space, we're going to say for the purposes of AML CTF, we're going to come up with some standards and some recommendations. So they have about 40 different recommendations for in just in general for money laundering, terrorism financing. But if you look at what specifically refers to virtual assets, there's quite a number, but particularly recommendation 15 to 21, which say that all countries in the next couple of years need to regulate to license and to register all these virtual asset service providers, i.e. exchanges, for the purposes of AML CTF. So you're seeing a sleuth of legislation come through because of the AML CTF requirements of different countries. And if you don't, as countries don't put this to the front of their legislative programs and come up with ways to legislate for AML CTF, they will be there's a chance you could be greylisted by the FATF. So that push has really come from the AML CTF regulator, and I think it's starting to now push the consumer investor protection that we see in security.
A couple of questions from our listeners. So I'd like to maybe just go pivot to those. We have one from Lake Player who wants to know how exchange control rules can be enforced, or how they can work together with crypto transactions in South Africa. He said the position in South Africa with that regard is a bit unclear, but I imagine it's similar in any jurisdiction.
If you're looking at your exchange control regulations, again, it's a piece of legacy legislation, right? So it's probably 1980 or in the 1800s, somewhere around that, right? And if you look at what they were thinking about, just let's protect flights of capital from the country, right? They were looking at physical, tangible things, gold bars, minerals, diamonds, that sort of thing. So it's a bit different in the context that we speak of with crypto, and that can be a separate discussion on its own. Does this fit crypto? Do we actually really need exchange controls and so on? And also, to bring it back to some preciseness. With current exchange control policy, exportation of capital or right of capital from the Republic is not allowed unless you get permission from Treasury being the Reserve Bank, or them acting through banks, authorized dealers, through delegated authority. If you look at the definition of capital, it doesn't include crypto. So a similar issue arose around intellectual property. Where you'd have assignments of intellectual property that is housed in South Africa. The technology is wholly assigned offshore and so on. That brought in similar issues, but at the end of it resulted in an amendment to the definition of capital within the South African context for exchange control. We would expect something like that to happen, and this is also strengthened just from our own engagements with the regulators itself. So you're in a gray area. There's a bit of gray. It's difficult to precisely call crypto capital because it's not defined as crypto in the enabling legislation, and there are legal rules towards extending the reach of legislation and so on, and you just can't do that. Our personal view is it's not capital. It's not catered for. It's not defined particularly as capital, and the Reserve Bank up to this point has not done much to clarify on that point. What they have done is to try and transpose the current rules on crypto. So that's why you have there's certain investment allowances that you have for individuals, single discretionary allowances. I think that's 1 million that you can export out. And this is across all assets, not just crypto, and it goes up to 10,000 with your foreign capital allowance, considering that your tax affairs are in order and so on. And with companies, it's a bit different. And what would be instructive is the authorized dealer manuals. Right? So they specifically set the specific instances through which companies and individuals can actually export funds. Well, that's the normal course. What we would expect, and so, well, in our mind, it would be something quite simple to employ. If we're going to take on the current exchange control policy, you can look at the current rules and the current permissible transactions, be it to companies, be it to individuals, and just apply something similar to crypto, which would be quite easy to do from a legal point. Granted, you may want to look into whether or not exchange control policy is in its current form is still necessary. The rest is really more of a process thing for exchanges. That would be reporting permissible transactions and doing some monitoring and so on. But up to now, there hasn't been much guidance from the responsible regulator, which is the South African Reserve Bank, in this regard. So not a lot of it is clear.
The problem is you're talking about a decentralized asset that's global in nature. When you talk about capital in and out of a country in a tangible way, that's quite easy to quantify. But with crypto, it does need, as we talked about before, very specialized regulation, because under the definition of capital or under the definition of a legal tender, does a crypto asset probably sit? No, I'd say it's more of a commodity. But I think this is where where the distinction between is something legal tender or is it not legal tender comes into how the prudential regulators look at this stuff. But it's very grey, and I think I always laugh at this, because when I leave Australia or I go into a jurisdiction, are you having more than $10,000 in cash on you? No, but you could be moving in a wallet and have your password in your head. A lot of crypto across borders without those requirements. So you have to. I think these things need to be dealt with over time, because they don't act like the traditional terminologies or definitions of things that we were using hundreds of years ago, because they don't work.
To the African jurisdictions more broadly, and we've seen a lot of adoption of crypto across Africa, and the regulators have been critical. This maybe putting it mildly. What do you think? What have you observed? Perhaps their approach or their reaction to the recent sort of FTX calamity?
I think when you look at the African continent, it's very, very different to much of the other world. I mean, I do a lot of work across Africa and India and in the Commonwealth countries. It's the adoption of digital assets across a lot of the emerging market is particularly high. Now, that I think there's a correlation, because in places like the US or Australia, where you don't have the financial inclusion level at, say, 96-97%, you put that on its head in the emerging world, and these assets become very, very, very popular and crucial, because a lot of the times the banking systems don't work. So it's interesting and how the regulators have reacted. I mean, I always think the unintended consequences of having knee-jerk reactions don't work. But I think the FTX fallout is probably not going to be particularly big in the emerging world as it will be in the US. Like I think FTX is a very US-centric problem, because it was in that part of the world. But I've done a lot of work across Africa, and I think one of the interesting things that I saw was after the central bank in Nigeria banned Bitcoin in 2019, the adoption of things like Bitcoin and digital assets went exponentially. So the unintended consequences of banning things doesn't work. It just makes these these assets go outside the normal manageable route of regulators. But I think this is where they have the most power and they are most transformative, is that when you can give I mean, I've always said, if we can with the internet, we can move information, but now we can, across open systems, we can now move information and value. And that is so transformative to large economies, and large economies of young people that don't have access to systems. So I think Africa is actually going to be okay with the FTX rollout. I just hope that central banks don't bring out bespoke knee-jerk reactions and do things like put total bans on cryptocurrency or make it legal tender on the other side of the fence, because I don't think that works. There has to be a level in the middle which protects consumers and investors, makes these systems safe for everybody, but also gives people the ability to be financially included in ways that we haven't seen because we haven't had technology.
We haven't seen much shaking in Africa, and we operate. We're live in a couple of markets in Africa. So the FTX thing hasn't particularly shaken Africa. We're still confident with the way regulation is progressing in some African countries. Granted, Africa is huge; it's like 50 odd countries, so things will differ from country to country. Sure. You have seen again, Loretta touched on this. I think governments have learned from it. So you will have the approach was, okay, we're not going to, well, in some countries it was banned outright. Criminal penalties, you go to jail. In other countries, they would say, okay, you can do whatever you want, but implicitly we're just going to ban it. We're going to cut your legs off with the financial services providers, banks. They close accounts, they don't operate accounts, and you sort of warn the public, deal with these guys at your own risk. You have no recourse. But given that you're driving most of this, if you're going to do that, you're actually taking it away from the formal market, which is not in your interest as a regulator, because you're driving everything peer to peer, and you're driving all the flows, all the transactions to an area where it is out of your sight. And I think regulators in Africa have seen that. And you can contrast the two biggest players in Africa. I think one being Nigeria and the other being South Africa. So the approaches were completely different. And within the African market, just because this it's emerging, the uptake is higher. African countries do see the potential for this by way of strengthening their banking systems. If you look at ease of transaction, speed, cost, and so on. And at the same time, there is an increased tax base from that. I think Kenya just came out with they're in a bot state with their bill and speaks to accounting for tax and all of that. So we're quite hopeful that the way the regulation has progressed in the US and other similarly positioned markets will not play out in the same way in Africa. And also you have to look at the use cases. So the use cases of crypto in Africa is very different from the States, right? So there's an investment focus in countries like the States and other Western countries. In Africa, it's not really the case. The case is to facilitate payments, and we've seen this because we're in the markets, is to facilitate payments. You want to hedge against volatile local currencies. So you typically have stable coins being involved there, and general financial inclusion. But you see this mostly at a company level, institutional level, at a retail level. It's not there yet, just because there's no wide adoption. I can't walk into a coffee shop and pay for my coffee with Bitcoin, so it's not possible yet. But yeah, quite hopeful on Africa.
Yeah, I think I do a lot of work across Africa with a lot of regulators across West and Sub-Sahara, and I think the difference is that regulators understand now the consequences of doing very knee-jerk reactions. I think this industry has shown it came from the shadows. I mean, there's no doubt this industry came from the shadows. But if we over-regulate it, we stifle innovation, it will just go back to the shadows, and you'll have no chance in high hell in the next 5 years of trying to control it. So we need, we need to have this balance of sensible regulation, but without stifling innovation, and that's a very, very hard balance. But I'll tell everyone right now, it's going to happen in places like India, Africa, and South Africa a lot faster than it's going to ever happen in Australia or the US.